Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everybody, my name is Minh and I'm your host from NDIS Property Australia, and you're listening to the SDA Housing Podcast. The show explains, highlights, guides and brings awareness about all things SDA in this ever-changing NDIS world. Today we have repeat guest speaker Rob Maxwell again. Rob, who's about to join our team in NDIS Property Australia in January. Rob, we're here to talk about investment fundamentals in property. I think that's the theme of today. Rob, welcome.
Thanks, man. Great to be back and talking about this topic.
Oh, this is an ongoing, regular topic which has to be reminded to investors all the time because they often forget the fundamentals of investing, aren't they?
Correct, and why they're doing that.
Well, what is invested? Let's talk about the basic answer. What is investment mean?
Well, again, it comes down to what you're trying to achieve, but the reason why anyone would invest money is to create an income and a capital growth return down the track that they can then use to supplement their lifestyle for whatever reason, whether it's for retirement or whether it's to pay down debt or just to increase their ability to be able to spend to fund their existing lifestyle. The only real way you can do it is either work and earn more money, or if you want a more passive way of doing it, that's such as property, where you don't have to become actively involved on a day-to-day basis, is to invest your money to see a capital return. Oh, yeah, high.
Mm-hmm. Okay. My question now is, do you think people who are jumping into SDA, NDIS property, are aware or know what, are they even following the fundamentals of the investing rules? Like, what's your impression of this SDA world and the investors coming in? That's my question there.
They may be getting a little bit focused or excited and encouraged to invest in SDA based on potentially what they've been told the returns are, which may be higher, as you know, than what they actually end up being. So they're focusing purely on the rental returns more than the actual capital growth or the reasons why they're doing it. But again, it does come back to it's all about emotion. If you think you can get these huge returns from investing in SDA, then naturally you're going to look at that rather than other forms of property. And that's never going to change. But people probably just have to be a little bit smarter and assessing the overall reasons of why they're doing it.
But wouldn't you agree that a lot of people, not everyone, a lot of people are throwing caution out the window?
Based on what they're being told and potentially they are. Although it's all cyclical. I think people will start to realise going forward that they need to have a look at their options more than perhaps what they have.
Yeah. So in this current property market, Rob, what are the options out there for property itself, in your view?
Yeah, well, I think the first thing to recognise and the reason why people invest in property is that it's done very well over 30, 40, 50 years in Australia or around the world because it's a very safe, secure form of storing of wealth goes forward. So obviously everyone looked at traditional property. The reasons why in Australia they might have moved a little bit away from that is the income returns have got a little bit lower. Government compliance and taxes have got a little bit higher. And of course, the cost is going up. So it's becoming less affordable to get a mortgage to be able to do that. So people are looking at their alternatives, which are SDA, that we touched on. Could be co-living or shared houses.
Rooming housing, that's right.
Rooming houses, which have probably always been around, but started to become more popular because there's a lot more single people in society that need somewhere to stay, that can't find the one-bedroom apartment or they don't need a house. So that's a growing trend. Then you've got the ability to put money into property syndicates and buy the share market. Yes, industrial property, commercial property. But again, commercial property probably is struggling a little bit in Australia. When you drive down the streets of all major cities, you see a lot of empty shops.
And Rob, by the way, it's hard for a normal mum and dad investor to jump into commercial property, by the way.
Yeah.
It's higher. It's the LVRs are different or lower. The entry price is higher, being, strata title offers at 250, 300 grand. or commercial offices at $1 million, $2 million. It's hard to get into commercial property. And the yields are also lower, Rob. And it's acyclical. I mean, we're talking about the average yield for commercial property is 6, 7, 8%. We're on a 10-year lease,
Which is all tied to interest rates. Yeah, interest rates, of course, went down a lot, then went back up, and now they're looking like next year they're going to start to decrease again. Then you've got newer forms of investment options that people are looking at, such as potentially overseas investment, less in houses, villas, hotels.
Which we've mentioned in the past, being Bali and fractional investing there, yes.
And fractional, which makes it more affordable for everyone. So they're always coming up with solutions to make property more positive and affordable again. Going forward, they might extend the timeline on mortgages to make it more affordable as well. Some like that's 40, 50, 60 years. That could become multi-generational, where families just roll over mortgages to their kids and their grandkids.
Yeah. I think with the housing crisis we have in Australia, the high interest rates we have currently with the RBA, the world instability, wars, politics, all that does have an impact upon, again, available housing, which is the most fundamental thing we need in our world, in our life at the moment. And hence the reason why we have investors coming in to find an edge to try to create wealth because of investing purposes. May I ask you, Rob, what's your opinion on interest rates? We've had very high interest rates the last 2 or 3 years now in Australia. And the big banks have been saying, oh yeah, we'll see a drop in the coming future soon. With Trump coming into the US and tariffs, what do you think the outcome will be the next year or 2 years with interest rates in Australia?
Yeah, well, in overseas, in the US, Europe, Japan, China, interest rates are going to aggressively drop. They went up really quickly. So after we had the COVID issues, banks around the world and governments rapidly reduced interest rates to try and stimulate demand and get money back into the system. Then we had high inflation worldwide. Now, in America and Europe, rates are actively starting to drop. The US is probably going to have another interest rate reduction in December. That's been forecast at about 9 to 7%, definitely going to happen. Trump coming in means he is very eager for interest rates to be reduced significantly. So he's going to push that from the government point of view. So America's definitely going to have a huge interest rate drop over the next year, which will stimulate demand, the money supplied, which will mean all assets will go up, whether it's the share market, whether it's property, other investments are probably looking very positive for the next year or so. Australia is proving a little bit more problematic and a bit of an outlier in that everyone will know that it's not easy out there. And Australia hasn't dropped the interest rates at all. And the RBA is what's called jawboning a little bit, I think. They're trying to suggest that interest rates aren't going to drop until unemployment goes up and inflation significantly drops in Australia because it's stubbornly buy. So Australia is a slightly different scenario. However, I personally believe that we'll eventually fall in line with the rest of the world because we always buy the US.
Rob, I hear you, but so many Australians are asking, when will our rates be dropping down? Because you're right. I mean, if these things happen around the world and tariffs and Trump and Europe and whatnot occur, as you say, surely we can't be this. We've been at this high for the last 3 years now. Is that right?
2 of the big years, yeah.
And we're hurting. Australians are hurting with high cost of living, housing crisis, and high mortgage rates. Interest rates were causing mortgage payments been so high. So you're saying that indications are that once inflation's down, and what other factor?
It's mainly to do in Australia with inflation. So the problem you've got to understand is the RBA are a backward-looking organisation. They're looking at data that's 6 months old.
Yes.
So I hear, and everyone's feeling it right now. You go out, everyone can feel as if things aren't going that well. Restaurants are struggling, hospitality, retail is struggling, but the data's not reflecting that to the extent that the RBA would like yet, but it will coming into next year. So I would say interest rates in Australia are going to start dropping around March, April next year.
Dropping as in one drop or multiple drops?
No, once they start dropping, there'll be multiple drops. But nothing's guaranteed. Australia inflation could remain stubbornly high in Australia compared to the rest of the world, but it will eventually fall in line with what happens in the United States. It always does, yes. Australia historically has always followed the United States. It's just how far that lag is in time.
So when interest rates come down, our listeners, the property investors, most property investors out there will look for an edge because their borrowing price will increase. Wages will have increased already. Interest rates dropping down. Serviceability
Will get better.
So these factors, criteria will impact upon people's investing decisions to move into property again, be it rooming housing or co-living or first home buyers or SDA investing or whatever it might be, right? It's going to trigger a confidence level for investors jumping back in again. So again, the topic here today is investing it's in property investing 101 pretty much, right? When that trigger happens, and we're reminding our listeners at the moment to be ready for that moment 6 months from now or 9 months from now, wherever we may be, please remind our listeners again, Rob, what are those fundamentals of investing? So they should think about it till Christmas or New Year, whatever. Yeah. The thoughts?
Yeah. Well, obviously, people have to look to preserve their capital. You don't want to lose your capital, but you need a good income that justifies the risk. And you have to have time. You can't jump into something thinking you're going to sell again in 6 to 12 months. You have to get retired. But assets in Australia, such as property, over time will continue to go up. I don't think anyone would dispute that.
Correct.
But everything's cyclical. There'll be periods like now where it may be, parts of Australia are doing really well. Melbourne's struggling, but that's more local issues to do with government. And also maybe that the influx of Chinese investors has dropped.
Land tax as well.
Land tax. There's just general issues related to there, but other parts of Australia are absolutely burning.
Perth, Brisbane, yes.
The more regional areas. And then when interest rates drop, I think everything will start to pick up again as people become a lot more confident.
I read in an article online yesterday, Rob, that for the year ending 23-24, 446,000 migrants came into Australia.
Yeah, and that's not going to reduce.
Well, the plan is, Peter Dutton's going, well, it was 700,000 a year ago. Now it's 446,000. And the goal is, again, his words being 220,000, but he realized they won't happen. You need to have that 300,000-400,000 number there coming in.
Correct, because that's what's popping up the economy and the GDP and obviously helping with housing, but it also will lead to a short supply.
Yes, and we already know the housing crisis already. So where there's a crisis, where there is, carnage, so to speak, there's always opportunity, yeah. And again, I'll remind our listeners and our investors, stick to the fundamentals of why you're investing in this. Why are you doing this investment, whatever it may be? What's your time frame? What's your risk? Diversification is irrelevant to here. And what's your exit strategy? Rob, not enough people talk about exit strategies. Do you agree?
Probably not. Correct. Yes.
Whether it's shares or managed funds or superannuation or property or whatever it is, no one really talks about exit strategy.
No, we need a plan in place.
And if you achieve your goals, then you look to cash in and take your profits.
People often say, "Oh, I'll never sell, right? There's always a price. There's always an exit. So be aware of that. And I bring this up because, Rob, so many people have jumped into NDIS property, SDA housing, and they need to take it through, and they have to exit straight away after completion because they had no buffer for their vacancy. When they went in, it was 2.5% interest rates at pre-approval. Now it's 7%, and they can't afford their interest rates. The NDIS has changed their approvals with funding, be it normal funding or SDA funding, which affects everything in the NDIS system. There are factors within the NDIS ecosystem that does affect SDA. For example, the profitability of the NDIS provider. Rob, tell me more about. I'm going off track here, but this is very relevant towards investing as 101 in NDIS property. Profitability of providers. Talk to me.
Yeah, I think as a general rule, it's a reasonably low profit area. It's not the cash cow that people might have thought of years ago. There were a lot of cowboys in the industry that were probably taking advantage of it and not doing things legally. They're being weeded out.
You're talking about providers here?
Yes, and just generally in the sector. The government's obviously conscious of what they're spending in the NDIS, so they're actually making cuts in relevant areas. The compliance for providers is significantly increasing, which adds to cost and time. So unless you've got a very large business and a lot of cash flow, it's not an easy area to set up and maintain a business in.
Well, I want to ask you a stupid question. And this is not me being stupid. I'm asking a stupid question that people are asking the question. 2 years ago, Rob, it was a cash cow. What are you talking about? Everyone's making money in NDIS. providers are doing well. Everyone's flocking to the NDIS world to be a provider, to be support workers, and all, allied health professionals trying to become NDIS approved as a support service, as a service in the NDIS. Apart from the NDIS mentality, the NDIS mentality of cutting costs, apart from that one thing, why have things flipped for providers to struggle? Why?
Well, there is a lot more involved with maintaining your license. The government's heading towards having everyone fully licensed, which adds cost and compliance.
Mm-hmm.
The rates that you get from being a provider to look after participants isn't high. You're talking $67, $68 an hour. Then you have to pay staff. You've got compliance. You might have your office, cars. So there's not a lot of money in it, because fundamentally it should be not a non-profit, but it's a community-driven sector who are helping people. So it's not like finance or big business or Wall Street, where the goal is to make a lot of money. The goal here is to help people who need help.
I hear you, Rob, but if the system is broken and it's not profitable for small businesses to provide support services to participants, and they closing shop, and there's less providers and less support workers, and people exiting the industry of care supports, surely that's not a good thing for the NDIS and participants. Surely not.
No, but everything has a way of working itself out and going through cyclical changes. And I think the NDIS is just going through a bit of a cleanup at the minute. It'll come through at the other end, and providers will find ways to make it more profitable. It may be less providers, so it may become more concentrated at the top end, sure. But service and what they provide will probably end up being better, more compliance. The government will be happy. They'll then probably take a foot off the pedal a little bit and not worry so much about cutting costs, because they'll see the benefits that it's providing. And remember, the alternative, such as I've talked about on another podcast, is that for the government to look after a lot of these participants themselves would end up costing even more money.
Yes.
So it's a cost-benefit scenario, and what they've got now is the best option.
Mm. So this last 10 minutes of discussion of NDIS funding and profitability, our listeners, is not going off track. It's to remind you that there are many things that play in the background within the NDIS and its future, which does have impact upon SDA property, because SDA housing is a property product, and we're trying to get returns and yields or reduced risk. But we can't control certain things like government changes, government red tape, and that's what we're trying to raise here with Rob here. Those things that are out of our control and more government changes or culling or whatever you want to call it, will have an impact upon the NDIS industry, which have an impact upon the SDA world of investing as well. Okay, just like land tax in Victoria, which impact on a landlord either holding their asset in further or not. Again, government change, government risk, regulatory risk, that also has an impact upon the NDIS SDA world here. Because as the Minister, Bill Shorten, said back in November or December, 12 months ago, end of 2023, the changes are going to happen in the next 5 years. And that will impact upon the future profitability and the sustainability of the NDIS, of which the SDA world, which is where we are sitting at the moment, that's why it's to our podcast, will be affected, rightly so or not, for the betterment of participants long term. So back to Investing 101. Again, we've all read prospectuses and IMs and booklets in the past 10, 20 years, where we see risks on the back of every one of these booklets. Open up your superannuation booklet, everyone, that you get. There's a table called risks, and those risks are interest rate risks, market risk, government risk, all those risks are all there, all fully declared. And the NDIS is no different, everyone. SDA property investing is a well-known property investment product now in the marketplace. And there is risks involved, and you've got to be aware of certain changes in the world of the NDIS, which does impact upon the SDA sector itself. Rob, anything more to add to this fundamentals investing 101 topic, which does impact on SDA itself?
No, just that we talked about government granted licenses are really powerful at creating returns, which property basically is a government granted license. The NDIS is an extension of that as well. People have to look at what they're trying to achieve. So it's all about, it's not the actual investment itself, it's what it's going to give you for your lifestyle or what needs down the track. Then put a plan in place, as you said. We are looking at ways to make the SDA investment more exciting again and opportunities going forward that we see in the market over the next year or two that we'll be just talking to people about as well. So look out for that. But there's always opportunity. Everything goes through cycles, up and down, and you just got to look at the opportunities in different areas, whether it's SDA, whether it's overseas investing, whether it's traditional property.
Yeah. Rob, thank you so much for your time. We're going to cover more of those opportunities in the new year in January 2025 when we welcome you back late January for another podcast topic, I guess, for such opportunities. If you are listening to this podcast show and you want to talk to Rob as well, please reach out to our office at 1300-254397 or email us on info@endos.property and we'll link you up to Rob, who's in Melbourne, who'll be doing SDA advice and sales transactions on behalf of investors who are looking for opportunities in Melbourne as well. Rob, thank you so much for your time. Appreciate it.
Sounds great, me. Thanks, everyone.
Bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.